Welcome to my channel. Today's topic is capital. Capital means funds brought by the owner. It is an investment by the proprietor or partners in the business. Amount invested to run the business for a long term is called capital. It is a permanent investment. So, from this, what we understand, any amount introduced for a short term will be considered as loan. It is a liability, so it should be repaid within a specified period. But if an amount is introduced for a long term, it is considered as capital, and this capital should be repaid only at the time of closing of business. Capital can be brought in the form of equity and debt. Equity means share capital and reserves and surplus. What is share capital? Any capital raised by way of issue of shares is called share capital. Then reserves and surplus means any profit not distributed and retained in the business is called reserves and surplus. It is also known as retained earnings. Retained earning means when profit earned in business is again reinvested in business. It is called retained earning. Capital can also be raised by borrowing because a company requires huge amount. This huge amount cannot be brought by the owner alone. Sometimes it becomes necessary for him to borrow loan from the bank in order to raise capital for the business. He might also issue debentures or bonds through which he raises capital for the business. Capital is a liability for the business according to business entity concept or separate legal entity concept. Interest on capital is an expense for the business. It is not paid in cash or by the bank but is added to the capital of the proprietor by increasing his total capital in the business. Journal entry for capital introduced. So entry is bank account debtor to proprietor's capital account. So money is coming in for the business. So it is debited. In other words, there is an increase in asset. That's why bank account is debited. And proprietor's capital account is credited because it is a liability. Liability should be paid. Or in other words, increase in liability should be credited. Interest on capital. So what is the journal entry for interest on capital? Entry is interest on capital account debtor to proprietor's capital account. Why interest on capital is debited? Because it is an expense for the business. According to the nominal account rule, we have to debit all expenses and losses. In other words, increase in expense should be debited. Then proprietor's capital account is credited because it is a liability for the business, or in other words, it is an increase in liability. Okay, let's discuss the answer for these questions. It is the funds brought in to start a business by the owner. So the answer is capital. Capital is the fund brought in to start a business by the owner. Next question. It is also known as net worth or owner's equity. Capital can decrease with drawings by the owner. Next one. Capital can increase with fresh investments in the business. Next one. Interest on capital is an expense. Thanks for watching. Please do like, share and subscribe.